Hello and welcome to Bazaar Ki Baat. We have Kshitij Jain and Vikas Agarwal with us, and today we will be talking about markets and investing broadly. The Indian equity markets have been rallying for quite some time now. The positive uptick has been clearly noticeable, and this has resulted in positive gains across the board. Let me get Kshitij in at this point. Kshitij, what do you think is really driving the Indian markets up?
I think largely, I would say the biggest factor has been the reversal of FII flows. Just to put into perspective, FII flows this year in the first 7 months have actually uh, recovered the outflow which we had throughout the year last year. So from that angle, it is a proper reversal of trend from FIIs.
So what is, like last year FIIs were not interested, this year they are interested. So what has really led FIIs to believe that India is the market that they should be investing in?
What I really believe is that the we have seen a lot of favorable macroeconomic factors, which has given wings to the India growth story, even in India and also in globally. So that has made investors believe in India so much more. So we have seen two factors, like we have seen moderation of inflation and the sustenance of GDP growth rate in India, which has made investors believe that the further interest rate hike is unlikely. And interest rate, we know, is a very important factor for an equity investor. And all the macro variables, even otherwise also, let's say inflation or currency, have been stacking up very well. While on also in addition to that, we are in a growth journey. So if I ask you any one of us, if let's say India will continue to grow from here for next 5 years, I think the resounding answer I will get is that yes, we will be growing while the world around us is slowing down. So that has been the big change, right? So we are seeing recession fears in US. Europe has its own problems with the war going on. China had I would say there was a possibility of it opening up after COVID, but it has actually shorted in its, has done a lot of damage to on its own in the capital markets. So that has resulted in India becoming a bright spot in the world. On the other hand, when I say domestically, we are seeing a paradigm shift from Indian households from their savings to equity, right? Which is contributing to this, I would say, rally to a certain extent. We are seeing continuous uptick in the SIP flows also, and they have been there for the last full year. So they have been there, increasing and sustaining also from,
Yeah. Yeah,
yeah.
so I agree that even from a domestic side, there has been a lot of retail participation, and everybody we talk to now, mutual funds especially has become a very very common part of portfolio for most people. But one thing that a lot of people have been asking me is that given that markets have seen such a sharp rise in the last 3 to 4 months, is it a good time to be in the market? Should they wait? Are the valuations too expensive? So, what is your view on what do the Indian equity market valuations look like?
So there is no doubt that the valuations have risen in the last few months. Large cap, I would say, is probably very close to its fair value. There are certain pockets in terms of valuation in small cap and mid cap, which have become moderately expensive, right, due to the recent run up. Uh, in my view, we may have some consolidation going forward, right? We cannot have such expensive valuation continuing. And that may be a good thing, right? Some consolidation may be a good thing because just a quarter of consolidation helps valuations fall by 3 to 4% because the earnings growth is anywhere between 12 to 15%. So from that perspective, the earnings catches up, and while the valuations come down. So that I think will happen at least in the near term. Over the medium term, obviously, India continues to be a bright spot as we have discussed.
Right, right. So we'll come to the small cap bit of what you said in a little bit, but before that, just let's just look at how the sectors performed. Largely, most of the sectors have been positive over the last few months, barring a few sectors which are still underperforming the Sensex, such as IT, FMCG, etc. So, what are the drivers that are really leading to sector outperformance, on a sustained basis over the last few months?
Yeah, so as you said, drivers is nothing but from if the whole broad, there is a broad-based rally. So all the sectors are doing well. Among those sectors, why some of the sectors are doing, I think I preferably doing well or will, or in I believe will do well is that we see that the capex theme will work well over a consumption theme, right? In India, consumption has been a theme for a while now, and at least for the past decade or so. But I would say probably now that we are in a cyclical turnaround, at this point in juncture, capex theme will be a better preference. At least that's what I believe. And we are seeing sustained momentum in cyclical indicators, capex indicators across India. Just to give you an example, we are seeing new home sales purchase peaking up, hitting all-time highs. The manufacturing PMI has been sustaining at a higher level. It hit all-time. I think it hit it was close to 57, 58 number in last 2 months. So all these indicators point out to the fact that there has been a economic turnaround or a cyclical turnaround which is happening, and the capex theme will continue to work well. Just to and obviously, when we talk about sectors, we cannot ignore that we are in amidst the earnings session, right? Earnings season is happening, so it will have an impact on performance. So from that
Absolutely.
perspective, yeah. So from that perspective, IT banks have been slightly impacted because though banks' earnings have been good, but there has been a NIM compression more than what the street was expecting. On behalf of the IT sector, as was expected, the numbers have been bad, and there is a marked slowdown there. Though I would say probably there the from an expectation versus the delivery, I think they're largely in line. Uh, so I would say from that perspective, I think some of the good earnings where they're coming, I see is that from autos and automobile ancillaries, they seem to be churning out good numbers in this earning season. So we have to, from an investor perspective, I think earnings would be the key trigger going forward. And the next big trigger would probably be the elections. So from
Mm,
that, from till now till elections, I think the earnings will what will drive the market.
right. All right. Interesting. So you spoke, you just, on the previous slide, you just mentioned about how, pockets of valuations could be expensive in the small cap sector. And, in my experience, I am seeing that because of the rally in the small cap stocks, small cap mutual funds have been giving very, very good returns. And now a lot of investors who are starting to invest now or are looking to increase investments now have suddenly become very, very interested in increasing exposure to the small cap space. So, do you think that that's the right thought process or approach to have as an investor, or there is something that we should be cautious about?
So as you've discussed, considering the recent rally, there'll be cases of stressed valuation. There's no doubt about it. But I believe the major thing to consider while investing in a small cap fund is actually the size of the fund, right? That is a big factor which you should consider before looking to invest. And we have recently seen cases of uh, uh, big funds like Nippon, Tata restricting flows, right? SBI small cap also has restricted flows, and they have stopped lump sum investment in their small cap funds. So why has been the case? Is I believe, though obviously valuations play a part, but I think a major factor of that is as the fund size grow as the funds grows in size, it is in small cap, it is forced to invest in a larger companies due to liquidity issues in India. So, and this is especially true in India where the promoters tend to have a higher stake in companies. Many of the smaller companies, you will see probably close to 60 to 75% of the promoter holding. So which leaves a very small share for the public investors to hold, and that causes illiquidity in the market. And we just ran some data, and which we are showing is that if we look at the data from Screener, this is as on 26th July, there are more than 4,000 companies which are listed in India across NSE and BSE, but only 1,300 companies, right? Only 1,300, just I would say probably one third of it, right? So only 1,300 companies have daily average trading volume of more than 1 crore, right, in the last 1 year, right? So that gives you the enormity of the liquidity dry up, which happens once you cross the large cap or the mid cap threshold. And further, if we move to further, if we increase this threshold, the numbers fall even drastically, right? So at 25 crores of daily average volume, there are only 378 companies, right? And now, just to why we are talking about these numbers, to put the whole thing in perspective and relating it to the small cap fund size issue, is that let's take a fund of 10,000 crore AUM, and let's say that fund wants to invest just 2.5% of that fund into a stock, into a single stock. And even then we are saying, look, let's say they take a buy call and they distribute their buying over a period of 10 days, right? So basically, they are only buying 0.25% of their fund on a single day. Then also, there are only 378 companies which are available to them, right? And of course, right. So these 378 companies would be probably the blue chips of the world, right? For a small cap fund, there is a big dry up of liquidity once the fund size increases, right? Or the other way how the small cap funds tackle this is that they will reduce their I would say position size, right? They'll make it 1% or half a percent, but then you end up with either 100 stocks in your portfolio, which is again a troublesome thing, or 200 stock as that is probably more not diversification, that is diversification. So from that perspective, it tends to hamper the style of the manager when the fund size increases, and that is true for all the funds, but large, I would say, a big factor for a small cap fund. And from that perspective, if you talk about Nippon, which is the largest fund in this category, that is a 40,000 crore fund, right? So the problem is even much problematic for them. So they might have to actually hold 200, 150 stocks for them to actually tackle this liquidity issue. I believe the main, I would say, summary, valuations is a point, but for small cap investors, I would say they should focus on the fund size a lot more.
I think that's a very interesting point, Kshitij, because normally, in the small cap space, most of the investors are only looking at the return part of it, and it's very difficult to identify when does the underperformance start. In fact, I think Nippon already has more than 150 stocks in the portfolio. So I think what you're saying makes absolutely sense. And while small cap is definitely value enhancing in the portfolio, one needs to be cautious about the kind of funds they are getting into, the kind of fund sizes that they are getting into, especially when it comes to the small cap investing bit. Thank you so much, Ritesh. I think that's very useful for our viewers again. So while we have spoken about the markets and the rally that has been happening over the last few months, I think it is time to step back and talk about the broader logic of investing. We have spoken about inflation in the past, but over the last few weeks, something that I realize is that while we all understand inflation, we don't really internalize the real impact that inflation can have on our lives. And I would like to invite Vikas at this point. to explain a concept which is very, very relevant for investors in terms of how they should really be evaluating their overall portfolio in terms of how it's growing. Because would you want to explain the terminologies of nominal and real rate of return before we really step into how they impact our real lives?
Hi, Shruti. I completely agree with your views that this is a very, very simple thing, but I think it has a profound impact when you think about your investments. I personally believe that in personal finance, simple things make a very, very high impact rather than looking for complex solutions. Whenever I am talking with a lot of people, I see that they are fixated about that. What is the return that I will get? What is the absolute number that I will get 10% return or 15% return? When I've seen investors behave in a different fashion when FD rates are 9% and when they are at 5%. But a lot of times I have seen that the real interest rates are very, very similar in both the scenarios. So today, what I wanted to talk about is nominal rate of return and real rate of return. So whatever investment return that you see on your mutual fund statements or on your bank like FD certificate, all these are nominal rate of return. This is the actual return that you have generated from your investments. But this does not factor in what is the current inflation which is going on in the economy. And whenever we are investing our money, the predominant idea of investing is that we should create wealth or it should have an impact on our wealth. So when the objective becomes wealth creation or thinking about increasing your wealth, the return which matters more to you is real rate of return. So a nominal rate of return is a return which does not consider inflation, which does not consider taxes. But a real rate of return is the return which takes like inflation within its purview. So when you compare real rate of returns, this is the actual wealth that you have created by investing. So uh, my request or my view is that you should start focusing about real rate of return. This will help you decide what is the best investment avenue for you over a long period of time. So like just to take some examples, if nominal rate of return you are getting from your FD is 8% and inflation is 6%, you are generating absolute return of 2%. But if say suppose you are getting a nominal rate of return from an FD at 8% and inflation is also 8, so your actual return is 0, but you may not realize it at a lot of times. So this is the broader point which I wanted to touch upon.
Right. And I think this is relevant because FD rates have just risen in the last 1 year, right? And like you said that you were talking to a lot of investors, and when the FD rates were prevailing at 5%, there were so many families who were coming and saying that, FD में return नहीं आ रहा है, where do we invest, return कहाँ से आएगा? And now when FDs are at 7.5, again those same people are back to, feeling that FD is interesting as an asset category. Whereas I think the purchasing power and the concept of inflation is just where it was. So, do you want to take us through why you think that inflation is really insidious and something that completely goes unnoticed by us?
Yeah, so this is just a small graphic which just which is trying to like convey a message that what you were able to buy in 1980 with 100 rupees is completely different at in the year 2000 and in the year 2020. So our capacity to buy the same amounts or consume same goods with the same money is decreasing every year. So we are not able to realize this, but this is happening every year. Now I'll just explain one of our client or one of my friend. He was I was just asking him a plain question that what is the taxes that you pay? So he said, yeah, I have a like salary of 1 crore and I pay 35, 33 lakhs taxes. And he had a lot of pain. So he was saying that I have to pay 33 lakhs of taxes. This is an actual outlay which is happening. But when I asked him that what is the net worth, he said that my net worth is 10 crores. So I said that, what do you think if you park this amount in FD, how much money you will make? He said, I'll make 7% less taxes. But he did not realize the fact that actual inflation is also taking away some of his purchasing power. For him, the net return was 4.5%. But actually, if he thinks about inflation, he starts thinking about real rate of return, he would realize that a 10 crore FD may not generate even like 1% wealth increase for him. Or maybe he is in a negative territory if we consider taxes. So This is just one instance I'm talking about. I have done a lot of sessions also at corporates, and whenever I pick up this question, people just don't realize that inflation is also a cost which they're paying on an annual basis. And this becomes more relevant when your wealth is slightly higher. So when you are in your earning years, your wealth is lower, you can still think that inflation is a low cost to you. But when your wealth increases, and if you are not able to generate real return on your investments, then you are actually losing out without you even being realizing. So this will not trigger an action from your end, but this will definitely have an impact on your wealth over the long term. So this is like a takeaway which I have seen when I've interacted with a lot of individuals.
A couple of years back, I was reading a newspaper or some magazine, and it said that inflation is the invisible tax that is always going to be there, irrespective of which
Yeah.
country you live in. And I think that's an important consideration to have, whether markets are highly valued or low valued, and irrespective of where the markets are, somebody who is investing for the long term, for long term goals, definitely needs to think more about inflation than market timing. And I think that's the big key
Yes.
takeaway from the session today. Thank you so much, Vikas, and thank you so much, Kshitij, for your time today. Hope our viewers enjoyed this session, and stay tuned for the next one.